business owners hear the phrase working capital is included during the sale of the business, but very few truly understand what that means until negotiations begin. My guests today help us break down what working capital actually is, what is included in it, and why it becomes such an important part of buying and selling a business. Welcome to Business Beyond You, the one-stop hub for insights, conversations, and perspectives business owners need to build businesses that last beyond them. Hi, I'm Sara Vaziri. I'm an AI advisor in the state of California, and my guest today is Ray Skog, CEO of Biz Pro Value, who is a certified business appraiser. Ray, welcome to Business Beyond You.
Hey, thank you. It's a pleasure to be with you here today, Sarah.
Thank you so much. Ray, so in most of the businesses we sell, there is always a big problem we have, and that's called working capital. That's why I invited you as an expert in this field to help us understand a little bit more about this whole subject. So in
Yeah.
simple language, what exactly is working capital in a business sale?
So, working capital is the thing that every new buyer worries about immediately after they purchase the business. Now, let me tell you why. Because working capital are those assets that turn over and are involved in the production and the sale, and they turn over regularly. And so we are typically referring to things like inventory if a company sells a product, or if they sell on credit, we're talking about accounts receivable. And so cash gets tied up in that inventory and in the receivable, particularly for a business that is going through a purchase and sale transaction. And we'll say the first 90 days of that business after the transaction has occurred, that's when it hits home, and the buyer is thinking 80% of the time is thinking working capital. They're not thinking, what price did I pay for the business? They're saying, I have profit, but where's my cash? And that is related to working capital. So it is the thing that they worry about, and it's typically related to items like inventory and accounts receivable.
Yeah, let's go a little deeper into what items are exactly included in working capital.
Yeah, that's a great question. So let's start with this framework, right? Assets create revenue. A company buys tools and equipment and uses that stuff, whether it's an oven in a restaurant or a truck in a manufacturing company. They buy an asset and it creates revenue, and then they have an operating structure and it creates profit, right? So assets are what creates that stuff. Fixed assets are, we'll call them a one and done thing. I buy a truck and I don't worry about it for 5 years or 10 years. However, when I take my cash and invest it in inventory, that starts turning over regularly, maybe every day if I'm a restaurant, or every 30 days or 60 days or 90 days, but it recurs. I have to buy inventory regularly. Well, when a customer or when a business sells something on credit, they are also effectively tying up cash in this accounts receivable. So again, I have profit, but I don't have cash. I have accounts receivables, IOUs, right? That a buyer is going to pay me, but not for 30 days. And I have to consume cash and buy this inventory that got sold to that person. All right. So the elements included in working capital are typically, the assets are accounts receivables and inventory. They're offset by a little bit of help called vendors, who sell a product on an interest-free rate to the business. I'll sell you a roll of carpet. You can pay me in 30 days. Now I have that carpet in inventory, and now I sell it to a buyer, but that buyer doesn't pay me for another 60 days, or I have it in inventory, we'll say for 30 or 40 or 60 days, and then I sell it and I don't get paid for another 30 days. So what we're talking about really, Sarah, is this cash conversion cycle. And
Mhm.
it's all uh, related to these working capital accounts.
So, I when we were talking, there were one important and very interesting point you brought up that a business can be profitable, but they still can have cash problem. Tell us a little bit
Yes.
more about that. How would that be possible? If I look at the business is profitable, how can that be in a bad situation as far as the cash they need to run the business?
Yes, that's right. I'm going to tell you a story, Sarah. Do you remember the movie Lincoln Lawyer?
Yes.
Well, the attorney was representing um, a leader of a collection of people, and
Hmm.
they drove motorcycles, right? And the attorney's job was to get the leader of the association out of jail. And they came to the court, and the judge says, "Do you have this information?" And that's what's supposed to release the leader, right? And the attorney says, "Well, I don't quite have it yet, and I need another week." They leave the meeting, they drive off, and the rest of that association, the motorcycle gang, pulls up and says to the attorney, "Why didn't you let our leader out?" And he said, "You haven't paid me your bill." And the motorcycle gang, the second in command, said, "We've got your cash." And the attorney said, "And that's the problem. You have my cash." So I have a recorded on the income statement. I provided services, but I did not receive cash. I made a sale. I have this engagement to get this guy out of jail, but I don't have the cash yet because I sold it to him on credit. Now,
Mhm.
if I'm a restaurant, okay, I buy lettuce and I sell it tonight. I buy it and then I get paid for it immediately. But some industries, like manufacturing or so on, they buy stuff, they improve it, they turn it into a finished product, then they sell it, then they collect, and it says, "I made a sale today, but I don't receive my cash for 45 days. I have profit, but I do not have cash." And that's the difference. And that's what every business owner will quickly learn in about 60 to 90 days. They have profit, but they do not have cash.
Yes, and if they don't have cash, they cannot start the second round of the production or service, whatever it is. So that cash management is actually very important.
Oh, yes. And think this, most small businesses are acquired with an SBA loan. Well, they have a loan payment due in 30 days.
Yes.
They've got, okay, and they did not have that originally. Not in addition to that, they have employees to pay on Friday.
Yes, sometimes it's very interesting. Like I get to talk to a business owner who want to sell their business, and they say, and they are very proud of this. Oh, I pay the invoices the minute I get them. I said, oh my God, that's not really a good idea. So that that kind of cash management is really important when they want to get to the time they want to sell their business. Tell us a little bit more about that, how important it is and what a business owner can do as far as that cash management before they want to get to sell the business.
Yes, that's a great thing. So there are three main areas that every seller should pay attention to. How quickly I turn over my inventory. That has to do with how much inventory I have on hand. Secondly, how quickly do I collect my receivables, the IOUs, the the invoices that are related to a sale? How quickly do I receive that? And then secondly, how quickly do I pay my vendors? That's the accounts payable turnover. Vendors will typically effectively loan money at an interest-free rate, and we call it an accounts payable. Now, sometimes there's an incentive to say, pay that invoice within 10 days because I get a 2% discount. And that's a very profitable use of money. However, the normal term might be 30 days. Well, I don't always like to say it, we're using other people's money, but effectively we're using other people's money. We're saying I can buy something, but I don't have to pay for it for 30 days. So if I decide to pay for it very quickly, then that means I need a lot of cash in my company. And a new buyer may not have that cash, right? So it's typically wise to be current with the payables in the terms agreed upon. If they allow you to pay within 30 days, well, then pay in 29 days. If they give no discount for prepayment, then don't pay it quickly because I need that cash probably to buy inventory or to sell a product and service on credit to a customer. If I've tied up all my cash by paying my vendors, I may not be able to issue credit to my customers and say, sorry, cash on the barrel. And they go, well, down the street, they give me 30 days. I guess I'm going to go down the street. So we want those things in balance. We want reasonable credit terms and we want payment terms that will not jeopardize the credit relationship that I have with the vendor.
But if I have set with them to pay like in 30 days, it's important that I send those invoices in time and follow to get my money in that 30 days. These are the important practices that they need to set before they want to sell their business. Otherwise, it negatively affects their sale.
Yes. So now let's talk about accounts receivables. I think what you're talking about.
Yep.
So the accounts receivables is sending that invoice the day that order is made or that sale is made or the product has been delivered, the job has been completed, or even progressive billing. The invoicing is very important. And here's an important concept. When we see that a company is not collecting their receivables within a reasonable period of time, it speaks to the transferability of a business because it might say we do not have a standard practice of invoicing our customers. And I get to invoice out whenever I can think about it or I remember about it. I know they're good. They'll pay for me. They'll pay me. I don't have to worry about it. However, that's not a reproducible system. And when a buyer is looking at a business, the buyer says, great, you've got $100,000 worth of profit, but it takes you 45 days or 60 days to collect from your customers, or it varies from year to year. This doesn't sound like you have a team of people who are running the business.
Yes.
That will give a buyer some pause to say, for a well-run business, I might pay a 4 times multiple on EBITDA. But for a poorly run business, which has more risk, I might pay only a 3 times multiple on EBITDA. The lack of a standard practice could cost the seller hundreds of thousands of dollars.
Not even that. Sometimes it makes the business not sellable because the buyers get stressed that is everything correct? They have a lot of, they need to trust the business they're buying. And when they see that there isn't any system or something like that, that's very stressful.
Well said.
Yes. So sometimes when we do valuation on businesses, business owners think that, okay, this is the value I get for my business. And then I have this much inventory that I need to get paid for it, or I have this. Tell us a little bit more about that. What is included in that valuation we always give the sellers?
Yeah, that's a great question. And one that we all regularly face, right?
Yes.
Okay. So let's go back to the assets, and we'll say that inventory is an asset, right? It is a current asset. We expect to turn that inventory over in less than a year.
Mm-hmm.
We expect to turn over that inventory in 3 days if I'm a restaurant, or maybe 30 days if I'm a retailer or something like that, right? Okay, so it is a type of asset. Well, we have to go back to the multiple source. And let's speak to a source of market multiples called peer comps. Peer comps is a single source of multiples, meaning they get all of their data from banks who have done SBA 7A business acquisition loans. So it's high quality and it is consistent. And what they tell us, though, is that FF&E and inventory is included in the price that was paid, and by nature, by then also in that multiple. However, they don't tell us how much FF&E and they don't tell us how much inventory. So what we have to do is think this. One, the FF&E is almost always included in the selling price. The trucks, the equipment, unless it's a non-operating asset. If I bought a truck or if I bought a forklift, placed it into service, we'll say in December of a year, that wasn't used to create these cash flows. That asset could be added to the value price. Now, when we come to inventory, we have to say what's normal. How much inventory is normal? Well, we might see some seasonality. In September, I have a lot of inventory. You know, if I'm selling popcorn at football games, I've got a lot of popcorn on hand, right? But if I am selling suntan lotion, I'm probably not selling any in February in Ohio, right? So my inventory changes throughout the year. So we have to say, okay, what's a normal amount, or what do I need when this business sells? Is it selling in February or is it selling in November? It might vary a little bit. So we look at one, inside the company, what is normal. Secondly, we look outside the company. And this is where we look at ratio sources like ProSite or the Risk Management Association, because now member banks submit information and they say the normal inventory for a company in this industry having this cost of goods sold is $22,000. And we measure that in the days of inventory outstanding. So now we can say a normal company or an average company, we'll say that, has $22,000. My subject company has $82,000.
Mm-hmm.
The multiple probably includes this normal amount, and the excess inventory, 80 minus 20, that $60,000 would then be added to the value of the cash flows developed by the multiple.
If we
So,
assume that that is a good inventory, is not a dead inventory, it hasn't been sitting there for a long time and all of those stuff.
yes, exactly. If it's obsolete, if it hasn't turned, it may be worth 21 cents on the dollar.
Yes. So what
Yep.
is the working capital peg? There is a expression that we always hear. Tell us a little bit more about that one.
Yes. Okay. So, based on the historical performance, we can understand what the cash conversion cycle is and the working turnover ratio. From that historical data, we can look at future data. Now, the buyer is not buying the historical performance, the buyer is buying the future performance,
Mm-hmm.
right? Okay, so the buyer says, I think this business is going to do $1 million in revenue. Therefore, I will need, by using these metrics of days sales outstanding, days inventory outstanding, minus days payable outstanding, the working capital numbers, it would say, I'm going to need $46,000 worth of working capital.
Mm-hmm.
And remember, this buyer is starting from a cold start. This buyer has no accounts receivables. That account receivable balance is going to build up immediately. The buyer is going to have a loan payment due. Okay, so when we talk about a working capital peg number, it should be enough working capital in the form of accounts receivables or inventory. It might be cash, but it's really what we're talking about is these ARs in inventory. How much do I need to keep the company running in its normal method? And we can calculate using that daily cash outflow times the cash conversion cycle to yield a number. I need $46,000. That is the peg.
Mm-hmm.
There should be $46,000 worth of fuel in the tank when I buy this truck.
Mm-hmm. Mm-hmm. So I can continue running it without any cash problem.
Correct. Now, I'm going to remember that this working capital peg may be increased by saying, I have to have enough cash to make my new loan payment. That's a whole nother equation that the
Yes.
seller did not have. And I have to have enough cash that I can go to sleep at night. That's called a minimum cash balance. So the working capital peg is what does the company need to operate? Plus, there may need to be some additional cash so that I can make my loan payment and I can have a minimum cash balance. Now, that extra amount may be and is the responsibility of the buyer. We don't want the buyer to put in their last nickel as a down payment and have no post loan liquidity.
Mm-hmm.
Okay. So when you ask me about this peg, it is this working capital, but I must also think about my cash budget. And that tells me that I may need to have not only $46,000 worth of working capital, but I may need another $25,000 so that my cash balance never drops below an amount that will prevent me from going to sleep at night.
That's great. Ray, you have a lot of information and I would love to go forever, but unfortunately we are out of time. So let me thank you for sharing your information and tell us if somebody wants to use your help to do evaluation or appraisal on their business, how can they reach out to you? Please share your contact information with our audience.
Sure. You can find me at bizprovalue.com, the website, www.bizprovalue.com. And you can email me at ray@bizprovalue.com.
Okay, awesome. And we will add your information under the video, but I would really like to thank you for your time and joining us with this episode of Business Beyond You.
Thank you so much. It was my pleasure.